Portfolio Builder members, today we have a new covered call in our SPY position. And this is what we've nicknamed the Rich Man's Income Portfolio. It requires you have at least $28,000. Now that's actually $28,128 to purchase 100 shares of the SPY ETF. And why we like the SPY ETF so much is because you can write 48-hour covered calls every Monday, Wednesday, and Friday for consistent retirement income. So this is a lot like owning a piece of real estate, except you don't have to fix up the property, maintain it, or talk to anybody. You can just log in every Monday, Wednesday, Friday, and write the covered call for consistent retirement income. We have no risk of losing the underlying asset. And Portfolio Builder's spreadsheet makes it super easy for you to follow along, copy what we're doing, and get the similar result. Today's covered call is the 280.50 3/6/2019 expiration. That's this Wednesday. $1.47 credit per share. In our portfolio, that is 17 contracts because we have 1,700 shares of the SPY ETF in a $2,499 credit. Now that's a little misleading because when we wrote this covered call, which you will see in the trade alert, the SPY ETF was actually trading above the price of the strike, and it was trading around 76 cents above that price. So that means we have to subtract the 76 cents that we are agreeing to lose on this if we are assigned, and that just means if the person who bought the call option exercises his right, we're taking a 75-cent loss right off the bat. But we took in $1.47 per share. So that's about 74 cents guaranteed profit on this trade if the SPY ETF were to jump up higher. Now let's say the SPY ETF goes flat until Wednesday or drops by less than $1.47. If that's the case, whoever has bought this call option loses a great chunk of his investment, and we get to keep all his money. And meanwhile, we're not worried about the S&P 500 a decade from now or 2 decades from now. This is the single most important security in the world. And so we have faith that if we have a long-term view at the S&P 500, we can generate consistent retirement income for decades to come. And it's the only ETF in the world currently that has the 48-hour covered call with extreme amounts of liquidity. Now, the big risk for us would simply be if the SPY ETF were to suddenly crater. And that's highly, highly unlikely. However, that is my main job, is to try to help you know when to sidestep potential downfalls in the market. And right now we are concerned about a sell-off in March. You can see January and February has pretty much gone up straight the entire time. And if we look at the 60-minute view, it's even more insane how straight it's going up. And this is because the Federal Reserve switched from being hawkish and raising rates and reducing the monetary supply for what was planned to be at least 2 years of balance sheet reductions. And now they've completely changed their voice. They said they're pausing the rate hikes and they're going to stop reducing the balance sheet likely by the start of Q4 of 2019. So the markets have been on steroids on that news. Meanwhile, China has printed trillions of dollars. India is relaxing. So all the major central banks are all currently very dovish in their stance. Meanwhile, hedge funds and retail investors were freaked out by the Christmas massacre and have not rejoined this rally yet. So once they do, this has the potential to really climb a lot higher. The downside for March is simply that the biggest buyer, besides the central banks, are the corporations. And the corporations, by the middle of March, will have reached a blackout period where they cannot buy back their own shares because they're in a time frame where they might be reporting earnings. And so all this leads to a healthy sell-off potential in March. Now, this is also backdropped with rumors that America and China are going to come to some deal. So we're not overly bearish in March, but you will see that I'm going to write the covered call strike price somewhat below the trading price. So we may get assigned quite often in March. And if that happens, we're going to generate usually a substantial profit. It just depends on how low we've written the strike price, below the current price. And so as we get closer to March 15th, and depending on how much bullish trade news is coming out, we will be protecting our position and still able to generate retirement income with this strategy. Now, for those of you who are new, you do get your own spreadsheet to track your trades, which I highly recommend. Puts you more into a professional hedge fund trader mindset, although we have by design made this an easy retirement strategy. Now, the good news is the SPY ETF has outperformed 99% of all hedge fund managers, all mutual funds. The only thing that has outperformed it is the QQQ ETF, which just targets the NASDAQ instead of the S&P 500. So by putting most of your wealth into the SPY ETF, you've essentially picked the single best hedge fund manager in the world in all of history that has the most money flowing through it every day, the most liquidity, and the most advanced options market. Not to mention the entire American pension system relies on this S&P 500 gradually growing over time. So simply due to the sheer amount of money printing that's expected to continue happening, the price of the S&P 500 will slowly but gradually inflate over time. And this allows us to use this strategy for retirement income without having to get too freaked out about the underlying asset going to zero. Now, if you did this with a basket of stocks, it's far more risky because now instead of having your wealth diversified in the top 500 companies of the world, you're now laying all your eggs into a few corporations who can have extreme volatility. Just look at Facebook last year, or NVIDIA's extreme 50% moves. So let's just do a quick review of how we use the platform. You start off by picking your allocation settings. We offer 3 model portfolios to follow based on 3 different types of people. The popular one is this SPY trading strategy. We put the target at 90% for income and 10% for cash. The 10% cash can be used to buy options to help hedge against primarily downside risk, although we do make some trades that play different angles as well. Next, you're going to come over here to the deposit area. This model portfolio started off with a deposit of $500,000 in December, and it has not done any withdrawals. Now, normally, if you were trying to generate retirement income, you would be withdrawing cash out of your account as you write your covered calls to generate income. And if we scroll back over here, we have different sections to track everything. Up here, it tells you trade alert based on your settings. It'll tell you how many shares of each ETF you should purchase to reach the target allocation you have chosen. So whether you want to follow our exact model portfolios or optimize it for your needs, that's totally up to you. And so we can see the target position in column I. We can see what we actually have here. We can see how each ETF represents a different region of the world, and we have a little bit of color coding to help us put this all together. So for the income strategy, it's the SPY ETF exclusively, and that's because it's the only ETF with extreme liquidity and 48-hour covered calls. Most other ETFs either have a weekly covered call or a monthly, and the downside to that is you can't adjust your strike prices as frequently to take advantage of retirement income from writing covered calls. And if we scroll over to the right, this is where we open positions. We only have one spot per ETF, so we're not doing any kind of crazy layering. This is really designed to keep it simple. We're not trying to have the best return in the world. What we're trying to do is generate consistent retirement income with the safest strategy possible. And there really is no safer way to generate this level of income than the SPY ETF. So as we finish a trade or cover it, we can move it down below to the closed option writing. And rarely we put on some small hedges. And these are all representing very small percentages of the total portfolio, anywhere from 1% to less. And this is primarily used to hedge our portfolio from downside risk. And once we close these long positions where we've bought a put option or a call option, we can close it over to this area. So that's our trade alert for the rich man's SPY covered call strategy. We have two other model portfolios we publish, which you can see our everyday move. This one is the poor man's income portfolio. It's based on the TBT ETF. To copy this one, you set your cash to 10% again, so you can buy options, and then 90% to the negative bond setting. And that is the TBT ETF. This is based on Jeffrey Gundlach's big prediction that the 20-year yield on the Treasury is going to go from the current 3% level and shoot up unexpectedly to over 6% in the next few years. So that's a big prediction. If you do your research, you'll see why it makes sense. The sheer amount of debt the government is creating compared to the demand for that debt is going to make long-term rates rise. And the historic norm is closer to 5%, so I wouldn't be surprised if this overshot before coming back down to 6%. So that's interesting. And if it doesn't happen, if the TBT just stays flat and the 20-year yield stays right around 3%, this strategy actually generates twice the level of income as the SPY ETF, and it only does it with one trade every Friday. It's the same strategy. There's just not a 48-hour covered call market, and there's a lot less liquidity. So you may not be able to go park $1 million into this strategy, but if you're trading $5,000 or $10,000 or $20,000, maybe even up to a couple $100,000, you should be having no problem following this strategy and writing the weekly covered calls. Now, again, we are at the risk of the Fed manipulating Treasury rates. If this Treasury rate were to drop to 2.75 from 3, the underlying TBT asset would drop a lot, quite likely by around 20 to 30%. So that is a reason why this is a riskier strategy than the S&P 500 and why it does have twice the return to date. It does hold more risk, takes less work, and only requires that you purchase 100 shares of the TBT to get started. New trade alert for this program will come out Friday. And typically we're just covering our position from the previous week and opening a new position in this program. Now, for those of you who just want to sit back, relax, watch your portfolio grow, and have some hedge built into your portfolio, so if things do get nasty, you can sell those positions and reduce your losses, this is the right strategy for you. Call it the lazy man, call it passive, call it whatever you want. It has a globally diversified portfolio that in the long run will likely outperform the last two strategies. And that's because it replaces the SPY with the QQQ and then diversifies into the EEM, which is China's colony of countries, Japan with EWJ, Europe, surprisingly, leading the pack since we launched this December 12th. Everybody's so freaked out about Brexit. Meanwhile, it's now the top returning ETF since we started this portfolio 12/10/2018. and then Asia, which is the little islands outside of China. And so you can see the specific countries each ETF is targeting and the weighting. This is what percentage of the capital that's going to this block of ETFs each ETF gets. So at the end of the day, we got 10% in the QQQ, 10% in EEM, 2% in Japan, 5% Europe, 2% in the coastal islands. And these are based on GDP numbers, but a few of them I have pushed up a little higher, like this one. And then meanwhile, we have a strong hedge right now, which I will pull off as soon as I think the coast is clear. Right now, things are a little murky with the trade deal not in place. We have a 20% SJB position, which is short high yield credit. If the stock market does crash, the corporate buybacks have to stop first. So I'm expecting the SJB, short high yield ETF, to rise prior to a full-blown crash. So this is a smart way to hedge against downside risk right now. And then we have the GLD ETF, which has done very well. So this literally put on the positions and has done nothing. Notice we're taking a loss in SJB, but that's the point of that position. GLD, surprisingly another part of our hedge, is actually the third best returning portfolio position in the ETF group. Now I do expect GLD to have some trouble if the Fed decides to start raising hikes and the other central banks decide the coast is clear. So most likely if we do get a trade deal closed and everything looks great, we'll start considering how to manage these positions, capture some profits, and think about what the new risk would be. So that's the update for today. We're keeping a look at a lot of leading indicators to try to predict volatility and help hedge our portfolios against the bumps in the road. Look for a new trade alert tomorrow. And